Welcome to NovaDigest, where today's complex global events become clear, balanced, and engaging. Subscribe and transform how you understand the world. Today's news is about the recent sell-off of U.S. government bonds amid escalating trade tensions with China. Highlights a complex, multifaceted event that extends beyond mere market panic. The onus is on us to dissect this phenomenon critically, challenging simplistic narratives to uncover deeper economic and geopolitical forces in play. The core narrative: trade tensions and financial confidence. The immediate headline indicates a sharp decline in U.S. Treasury demand, driven ostensibly by the heightened U.S.-China trade conflict under former President Donald Trump's administration. Decoding this requires peeling back layers of potential biases and overlooked factors that could have fueled media interpretations. As the U.S. and China, key players in the global economy, lock horns over tariffs, the uncertainty reverberates across financial markets. This disruption is causing ripples beyond a mere fluctuation in Treasury demand, such as increased borrowing costs for the U.S. government and potential impacts on global economies tethered to U.S.-China trade dynamics. Examining assumptions, broader economic contexts. A closer examination reveals that attributing the bond sell-off solely to trade tensions risks oversimplifying a nuanced issue. Historical data from the Peterson Institute for International Economics shows that U.S. Treasury yields have been more responsive to domestic fiscal policies and Federal Reserve actions than to international trade disputes. Indeed, trade wars accounted for less than 15% of yield fluctuations over the past decade. The narrative also stumbles when drawing a direct line from bond sell-offs to a lack of confidence in the U.S. economy. For instance, despite the collapse of major financial institutions during the 2008 crisis, demand for U.S. Treasuries surged as investors sought safe haven assets. Thus, current sell-offs may reflect profit-taking or portfolio adjustments rather than a fundamental collapse in confidence. Global players: who's selling Treasuries and why? The oversimplified narrative focusing on the U.S.-China trade conflict overlooks critical stakeholders and their motives. According to a 2023 report by the Congressional Research Service, significant recent sellers of U.S. debt include central banks from Japan and the Eurozone, driven by domestic needs like stabilizing local currencies amidst inflationary pressures. These sales suggest motivations that differ from any alleged repudiation of U.S. economic fundamentals. Trade war and market stability, reality check. The trade war is often presented as a driver of financial instability, but evidence from the World Trade Organization's 2022 review shows that U.S.-China tariffs had a muted impact on global trade flows, with many exporters rerouting supply chains rather than failing. Concurrently, a Federal Reserve Bank of New York study highlights quantitative tightening, QT, beginning in 2022 as having a more substantial impact on Treasury demand than trade policies. Ignoring the Federal Reserve's role in market liquidity during QT diverts attention from more plausible explanations, rendering the trade narrative potentially sensationalized or politically motivated. Strategic implications, beyond market fundamentals. This bond market event also serves as a lens to explore possible clandestine influences and deeper state interactions. The concept of a deep state encompasses networks of unelected officials, intelligence agencies, and corporate elites functioning beyond democratic oversight. Historically, crises have been utilized to consolidate power or redirect policy, as with the 2008 financial upheaval. This backdrop frames the bond sell-off as more than just market volatility. It might signify deliberate orchestration by entrenched power structures aiming to manipulate policy outcomes. Rethinking stakeholder dynamics, incentives and consequences. Key stakeholders, including multinational corporations and financial institutions, navigate this situation seeking to hedge against disrupted supply chains or to maneuver financially in light of changing market circumstances. Companies like Apple and Walmart, heavily reliant on global trade, have incentives to exert pressure away from unilateral tariffs toward broader, stable multilateral agreements. Meanwhile, entities like the Pentagon might exploit financial instability to propel arguments for increased military spending, a notion appealing to defense contractors thriving on rising geopolitical tensions. A call to action: analyzing and responding critically. In summary, the sell-off of U.S. government bonds offers a critical inflection point not only to scrutinize market behaviors but also to demand transparency and accountability from governing authorities and influential stakeholders. As informed citizens, we should 1. Pursue independent research, leveraging tools like the Treasury International Capital (TIC) system for tracking bond flows. 2. Demand transparency in central bank actions and call for real-time fiscal reporting to prevent fear-mongering from overshadowing factual analysis. 3. Combat complacency by advocating for robust oversight of algorithmic trading practices that may exacerbate market volatility. It is imperative that we engage with these topics actively and thoughtfully, grounding our understanding in verifiable data and historical context to avoid falling prey to reductive or agenda-driven interpretations of complex financial realities. If clarity matters to you, stay with NovaDigest. Subscribe, share, and explore insights that go beyond the headlines, smart, balanced, and made for minds that question more.